Hello and welcome. Thank you for joining us today. My name is David Webianr, and I'm joined with Dr. Michael Langermeyer. Today we're going to do our quarterly update on the latest results from the Purdue University CME Group Ag Economy Barometer. The Ag Economy Barometer is a partnership between the Purdue and the CME Group, and we've been collecting data for about, 16 months now. Back to October 2015, we've been surveying producers on a regular basis, asking them questions about their operation and their outlook towards the ag economy. The results have been released since May, and so we have quite a history here that we're starting to build up. Most recently, all the surveys we do is a group of 400 producers from across the country, and they typically represent corn, soybeans, wheat, cotton, beef cattle, dairy cattle, and hog producers as well. And so we ask questions that focus on 5 main questions focuses on their outlook. And those 5 questions go into the barometer index itself that we'll look at here in a little bit. And then the balance of the survey looks at the key drivers that are influencing producer sentiment and the changes over time. We ask about farmland value expectations, commodity price expectations, macroeconomy expectations, as well as maybe production expense changes. So that's a little bit about the barometer. You can visit our website, purdue.edu/agbarometer, and there's actually a YouTube video in the archive that a colleague and I spent about 30 minutes really going into the details of the methodology of the survey. And there's also some text on the website that outlines that as well. So we encourage you to visit that for a bit of background on the barometer itself. But today we're going to talk about the latest results, which were from the January survey. The 3rd week of January, we surveyed producers. And we're going to talk about the latest results from that. If you have any questions during today's webinar, feel free to email them directly here to the studio. It's dwidmar@purdue.edu. That should be at the bottom of your screen. And if we don't get to your question today on the air, we'll definitely follow up later on this afternoon or tomorrow. So with that, we'll go ahead and get started. Since our last webinar featuring the results, ag sentiment has trended higher. Much higher than what we've seen in the past, the year beforehand. In last October, sentiment post-harvest was at 92 points, and today it's up as 153 points, a strong turn in sentiment for producers.
Do you want to talk a little bit about the base period here that we use for the index, David?
Yeah, so for a reference point, 100 is our base, and that's the 6-month average from October to March of 2016. So the average of those 6 months is 100. That's kind of the starting point for this project. And the range of possible outcomes, mathematically speaking, is from 0 to about 320. So this gives you an idea of where we're at today. And we spent a lot of time prior to October or prior to November, the last 3 months, kind of bouncing up and down around that 100 mark. We trended lower through last spring as producers were getting ready for the planting season. The budgets were looking tough and commodity prices trended lower. Then we set up higher as through the early summer when commodity prices trended higher. And then we've also settled lower through harvest with big yields and declining crop prices. But recently we've had a big uptick higher. And from the barometer, we can look at the data in 2 different ways. One of them is through the index of current conditions and the index of future expectations. And this gives us an idea of which element. Is it today's kind of reality, or is it the future expectations that's really pushed sentiment higher? And that's what we're going to show here on the graph right now. So in orange is that index of current conditions, which was around 80 points back in August, got as high as 87 back in November, and then really took off in December and January. You want to talk a little bit about what might be driving that, Michael?
Well, certainly, if you look at futures prices, you would think that would have an impact on the current conditions. Higher yields would certainly be a factor there. I think that would be 2 of the larger factors. I don't know if you can think of something else that might be there.
I think that's a lot of it. So there is economic conditions, and the balance sheets have improved a little bit, but it's worth noting that at 118. That index of current conditions is kind of within the range of what we've seen previously. Previously, there's a high of 125 back in December last 2015, and then previously at 118 as well back in October. So we really haven't left that range. The real story here, of course, is in that index of future expectations. In November, December, and January, we've set new highs. We've trended higher at 169 points, and that's really left the range of what we've previously seen.
And David, let's talk a little bit more about what's in the index for future expectations. There's some questions in there related to looking a year ahead, but there's also at least one question in there related to 5 years ahead. So talk a little bit about that.
Yeah, so specifically within that index of future expectation, there are questions that ask about what producers expect their farm's financial situation will look like a year from today. And there's also a question that asks them to think about the broad ag economy 5 years from now. Do they expect widespread good times or widespread bad times across the overall ag economy? So there's definitely a couple components to that future looking, but really this uptick in sentiment has been driven in a small part, but a significant part, by higher commodity prices and big crop yields. That's that index of current conditions. The large driver here has been this strong uptick in the index of future expectations. To look a little bit at what the barometer, some of the specific questions that we ask about the barometer, and this is a really important one to look at. The question is, do you think a year from now your farm operation will be better off, worse off, or just about the same financially speaking? And on the graph, we have the percent of respondents who shared better off. In January, that got as high as 39%. We spent most of 2016 kind of bouncing between the high teens, 16%, 17%, up to about 25%. So recently, that's trended kind of outside of that previous trading window. Anything to add here, Michael?
Do you know how many were neutral in this particular graph? Because a fairly high percent were neutral, and obviously if there's 39% better, the remainder are neutral or worse off.
Neutral or worse, yeah. So there's three options that you can answer this question, and I don't have that statistic off the top of my head, but
I think it's important to point out that 39%, there's still 60% that were either neutral or worse off, and so we have to keep this in perspective. The future expectation index is up, but there's still some people that are fairly pessimistic about what things may look like next year.
Yeah, so on one side of the coin, the optimistic side of the coin, last year, about this time, 13% said they thought their operation would be better off a year from now. So if you had 10 producers in a room, one of them thought that they were going to be in better shape a year from now. Today, that's about 40%, 4 producers.
That's a good analogy.
That they think their operation is going to be in better shape a year from now. So as you pointed out, it's a growing share. This is trending higher. This is feeding that optimism looking ahead, but it's still less than half. So there is a majority of producers think a year from now will be about the same or worse financially. It's 60%, as you pointed out. Another way that we can look at these questions, this is more of a part of the index of current conditions. Both these questions feed into the overall barometer. The question is, would you say that your farm operation today is financially better off, worse off, or about the same compared to a year ago? So now we're looking kind of backwards and how the operation looks today relative to the year before. And this is a percent of respondents saying worse off. A majority, even in January, with the higher sentiment, a majority are still saying that their operation today is worse off financially than it was a year ago. So this really highlights that there are still tough times financially on the farm.
And we'll look at liquidity and solvency a little bit later. Some people might be thinking, well, my yields are a little higher, so my cash flow may be similar or slightly higher than last year, but certainly from a liquidity standpoint, they're probably worse off. And so we don't really delve in exactly what they're thinking about when they answer this question, but there's a lot more to this than just cash flow. It's cash flow, it's liquidity, it's solvency.
Yeah, there's a lot of specific elements that go in it, specific ratios or metrics or measures, and this is just kind of a broad stroke look at how producers are thinking about their operation. This is at 58%, as we noted earlier, and we were about 58% back in December 2015, so we're not at record lows in this particular question. Again, looking at this question and the previous question, I think those two really underpin the idea here that there are still tough times out in agriculture. Producers are very aware of that, and they're sharing that within the survey. So this improvement in sentiment that we've noted in the last 3 months is really an improvement on a bad situation. We're not saying that we've reached some sort of good time in agriculture, and that's not what the survey results are saying otherwise. So it's an improvement on a tough spot that producers are in, especially an improvement as they look down the road. Another question that you and I have been watching very carefully, and we find it very interesting, is we ask producers if now's a good time to buy large farm investments like buildings or machinery. And this is actually one of the most consistently responded questions, or most consistent responses over time from producers. And this is a share telling us that it's a bad time. A majority, 64%, saying it's a bad time.
Yeah, like you've said, David, this has been very consistent. Approximately 2/3 have said since October 2015 that it's a bad time to purchase large investments. And certainly, if you look at the auxiliary data, on machinery sales, that would bear that out. If you look at capital spending indices of Federal Reserve Bank, it would bear this out. That certainly farm machinery sales are much lower than they were back in 2012, 2013. And so we're watching this very carefully, because if this would swing downward, less percent think it would be a bad time, that would be a signal. Maybe people are going to start buying more machinery again.
So, kind of tying this back into overall sentiment, we've seen sentiment change. That first couple graphs, that's changed quite a bit, but this has changed relatively small, and this kind of ties into this. Outlooks have improved, or sentiment towards the outlook has improved, but farmers haven't really told us that they've left the sidelines to start maybe going out and making purchases. So they're feeling better, but they haven't necessarily gone out and made those additional purchasing decisions. Switching gears just a little bit, we think that commodity prices are, of course, an important story to how 2017 and the future of agriculture looks, and specifically, where do commodity prices kind of settle in at? Do we settle in more around $4.25 a bushel, or is it more $3.50 a bushel for corn? So we asked producers in the latest survey, we asked them, what are your expectations for commodity prices between January and the fall of 2017? More specifically, we asked about the corn and soybeans future contracts, and we asked if they thought the corn futures the December futures contract for corn would exceed $4.25 per bushel over the next few months. That would be a new contract high, or would it fall below $3.50 a bushel? Again, that's a new contract low, and about even split between the two of them. 38% thought that exceeding $4.25 per bushel on corn was possible, and a similar share, almost 40%, thought that a new contract low would be possible, setting prices below $3.50 a bushel.
A little more optimism there with regard to soybeans, David.
Yeah, so slightly more producers at 44% think that new contract highs or exceeding $10.50 per bushel was possible, and a smaller share, about 35%, thought that new contract lows below $9 per bushel was possible.
It's very important to point out here and make sure the people that are listening here are very clear on this. This is future prices. This is not cash prices. And so we're talking about December corn futures and November soybean futures. And so make sure you note that. But let's talk a little bit about break-even price or cost of production relationship to these graphs. And if you look at high productivity soil in Indiana, for example, the break-even price in 17 budgets is right around $4. And so if that $4.25 comes in, that's a pretty sizable profit, if you will. That's a much different situation, obviously, than if price is $3.50. At $3.50, we've got quite a bit of production costs that have to come out in 2017 to hope to break even. So that's a very, very big difference, from a profitability standpoint, looking at $3.50 versus $4.25. And the only reason I point that out, that's pretty obvious, that's a big difference, is that huge divergence in expectations here. Between $3.50 and $4.25, and we've asked this question before, and it's been wide divergence of opinion before.
So I think this is one of the neat parts of this project that we've been able to capture, in addition to the Measuring Sentiment Monthly, is that this is a wide range of prices. $4.25 is a pretty positive outlook
price,
in the budgets for corn. $10.50, same for soybeans. But these low price ranges, $3.50 for corn, $9 soybeans, it's a pretty difficult situation for producers on their budget. And there's a fairly large group of producers, almost 30 to 40% in both commodities, and they both think that a high is possible and that a low is possible. So there's kind of two camps of optimists and pessimists out there, and they're pretty sizable groups. I personally was a bit surprised that those expecting breaks to the high end and the low end were about the same size and to that large of a group.
Yeah, I really thought before we got the survey results here that there'd be a smaller percent below $3.50 and $9 in this particular survey. I think that's what you were probably thinking too.
Right. No, I think that's a great point. So this is a really, I think, key unknown or key question for producers and everyone in the ag community is where do commodity prices, where will they take us in 2017? And surveying producers, there's, I guess, a wide range of thoughts out there that they're thinking about. Another question, more long-term, that we've asked about in the most recent survey is thinking about the regulatory environment that producers are thinking about, maybe beyond 2017, thinking the next 5 years down the road. So a new question to the barometer. We have, first time we've asked that in January, so we really don't have a base period to reflect this on or compare this to. So the question we ask is, do you think the regulations impacting agriculture will be more restrictive, less restrictive, or about the same 5 years from now? And 41% of respondents told us they thought there would be less restrictive regulations in the ag environment 5 years from now, and about 30% said about the same. And another 30% said they thought there would be more restrictive regulations. Do you have anything that...
Yeah, it's hard to put this in context because we haven't asked this question before, and so I don't really know what the expectations were, but I know some of the politicians campaigned on being a less restrictive environment, and I think that's being picked up in this slide.
In the thought being that less regulations, less restrictive regulations could be a favorable signal for businesses, and that it could be less of a barrier for them, and could translate or trickle down into more profitability on the operation. I think this question is particularly insightful when you combine the two groups at the bottom. So 71% of respondents thought that the regulations facing agriculture would be the same or less restrictive 5 years from now. I think that's a pretty big group not expecting additional regulations moving ahead.
No, you're right.
So Michael, transitioning a little bit away from the barometer, and usually for ag economists, there's not a whole lot of new news coming our way, but we released these results on Tuesday, and later in the day, the USDA came out with their latest estimates for net farm income and the first look to 2017. So can we talk about that a little bit?
Yeah, let's look at that. This is the new information from USDA ERS, fairly fresh off the press earlier this week. And the 17 number is very similar to the 16 number. If you look at net farm income, it is down another $6 billion or so there. Net cash farm income is actually up slightly, and so certainly they're expecting 17 to be somewhat similar to 16. That's not necessarily good news because obviously from this graph we've seen a large drop from the high in 2013.
And so the decline in 17 is about 9% from 2016, but it's about 50% from the high in 2013. Yes. I think that's the bigger story here is that we've come a long ways down.
Yes, we have. Let's go to the next graph, David, and look at this kind of post-2007 and pre-2007. The reason I'm picking 2007 here is 2007 is kind of the start of the ethanol expansion period, and so that's why I'm using 2007 forward for one of the lines and then pre-2007 for the other line. And so assuming that we're in this post-2007 period and assuming that we're going to think U.S. net farm income is going to be around that $80 billion, we're considerably under what that average has been from 2007. Just to put that in perspective, we've only had 1 year since 2007 that was similar, and that was 2009. And moreover, 2016, 2017, it's been a while since we've had 2 years that are that low, because if you go back to 2008 was a pretty good year, 2010 was a pretty good year, and so that's why we're seeing more liquidity problems and debt increasing, because 2 years like this that are substantially below the long run average is going to be problematic financially.
So you mentioned liquidity and solvency. So let's talk a little bit about what we know from those aspects.
This is a really busy graph, and so I know that. There's a lot going on here, so let me just go through this relatively slowly. The green line is loan demand. This is what they call a diffusion index. Federal Reserve Bank of Chicago, Federal Reserve Bank of Kansas City, and other Federal Reserve banks use these indices to kind of get a feel for what's going on with loan demand, capital spending, loan repayment, and other items. Here we're looking at loan demand and loan repayment. So the green line is loan demand, and we can see here for the last several months, actually for the last couple years, loan demand has been above 100, meaning that there's quite a bit of loan demand compared to what there was year over year. That's kind of the way they ask this question, is year over year. And so loan demand's going up. That's very consistent with the rise in debt that we've seen if we look at the U.S. farm balance sheet. And so that's one item related to liquidity. Obviously, if your demand's high, it means you need more money for operating, pay your term loans, and other things like that. At the same time, loan repayments going down, and so we're having more difficulty repaying loans. That's actually the blue line there. It's come up a little bit in the last couple quarters. It hit a low there in the first quarter of 2016, but historically it's still really, really low, this loan repayment. And so the combination of loan repayment problems, as this graph would indicate, and loan demand increases is really what I'm calling this liquidity crisis. It really means behind the scenes here that more farms are having trouble with their liquidity and having to borrow money, borrow money for operating, borrow money to pay term debt.
So to kind of recap this a little bit, the Chicago Federal Reserve Bank is surveying farmers, or not surveying bankers about the farm situation or the farm loan situation. And they're doing this on a quarterly basis, and we got a long history of data here. And so in the last couple of years, ag lenders have been saying the demand for loans has gone up, and their concerns about repayment or their perceived repayment capacity has gone down. So more debt, more concern about the repayment, or less confidence in the repayment ability, has kind of put us in this squeeze that we haven't seen really. So loan demand, the diffusion index, peaked levels that we hadn't seen previously
for
until
quite
the
some time.
70s and 80s,
yeah,
and
quite
that was
some time. And these indices haven't really moved in opposite directions. Particularly one going, loan demand going up and loan repayment going down for quite some time. We saw a period there in the early 1980s, late 1970s, early 1980s where that happened. And so this is a little bit uncommon, but it's a classic case where liquidity is being squeezed a little bit.
And so this is kind of a look at what lenders are thinking about, and another kind of look at what's another opinion, I guess, on what's going on in the ag economy. So you mentioned solvency. You mentioned some the debts and the assets and the equity. So let's look a little bit about what's been going on in those actual metrics.
Before we do that, let's refer back to the 1980s. The 1980s, we had a liquidity crisis and a solvency crisis. And what I mean by that is cash flow was really tight, and so that put pressure on our liquidity, which current assets minus current liabilities. But we also at the same time had higher debt levels, and we had problems because of those higher debt levels. Making payments on term debt, very high interest rates. Exports declined, and various other things. So we also had a solvency crisis, and you can see that here. If you look at the early 1980s, this is using U.S. averages. The debt-to-asset ratio climbed dramatically from about 1978, 1979 to about that 1984 to 1985 period. And that's why the 1980s was so bad, because we had both a liquidity and a solvency crisis. We've already indicated that they were currently in a liquidity crisis where liquidity is substantially tighter than it was. We're not yet in the solvency crisis. Debt has upticked, has increased here the last 2-3 years. The debt-to-asset ratio in 2012, for example, I believe was 11.3. Fairly low. In 2016, it's closer to 14, and so we have seen an uptick there, but it's nothing like we saw in the early 1980s. And so we're not in a solvency crisis right now. We'd have to have a lot more debt in the system and a lot more sharper declines in asset values. We've seen some deterioration in land values. This is on a U.S. perspective, we've seen more deterioration in land values in the Corn Belt than we have for the U.S. as a whole. So we have seen that, higher debt, lower asset values, particularly land, but nothing like we saw in the 1980s. And so we're not in a solvency crisis right now.
So to recap a little bit, we're concerned about liquidity.
Yes.
Liquidity is really covering the bills we have in the next year.
Yes.
In declining net farm incomes and rising debt levels are a really the concern there. That's the liquidity concern. More long term, we think about solvency,
Yes.
and that's really this debt to asset. How much assets do you have relative to your debts? We were at historic lows for debt to asset and debt to equity in 2012 and 13 and 14. So the boom era in agriculture set us up in a healthy condition, and we've seen that healthy condition kind of erode in the past few years, but the starting point was good, and we really haven't passed levels that we would have saw in the 90s, kind of a stable period in agriculture.
Now, to put this in perspective, we're just showing the averages here. We all know that there's a certain percent that are in a much different situation than we're seeing than the average. If we were looking at liquidity and solvency, we have some farms out there, and it's not just one or two that have both a liquidity and solvency crisis. But just looking at the averages right now, liquidity crisis is very real. The current ratio, for example, is considerably lower than what it was a couple years ago, but solvency for the most part it's not that high right now, even though we've added debt in the last 2-3 years.
So let's talk, in our final few minutes here, let's talk a little bit about some of the differences we're seeing across the country. There's been some articles out and about talking about kind of the pain that producers are feeling hasn't been uniform. So Michael, do you have anything to add to that?
Well, let's contrast Western Corn Belt and Eastern Corn Belt. You're actually originally from the Western Corn Belt, and so I'll ask you the question, flip it around, and what does the Western Corn Belt look like compared to the Eastern Corn Belt? Has it been rougher out in the Western Corn Belt?
So what we've seen, I guess, is really low commodity prices for wheat. We think about the Western Corn Belt of the High Plains as really a wheat-producing part of the country. And they've had a series of good crops and a lot of competition globally for markets, and so this put them in a low price environment. We have really abundant inventories out there.
Stocks are high.
High stocks
worldwide.
So low futures prices, and then high stocks impacting the basis. So really low cash bases. So the cash price is low. We've seen LDP, kind of that loan deficiency program back from the 90s and early 2000s. That's been in play out there. And so what we've seen is really tough financial outlooks in that particular part of the country.
Yeah.
I think,
and then you add to that, David, the weakness in calf prices compared to what they were a couple years ago. I mean, calf prices are substantially lower than what they were a couple years ago. 2017 looks like a better year for cattle finishing. Famous last words, but right now at least it looks like it's much brighter than it has been. But 2016 was rough from a cattle finishing standpoint, and so I think if you add the wheat to the beef, the Western Corn Belt's feeling more hurt right now than the Eastern Corn Belt.
Yeah, I think that's a really good point. In fact, the USDA in January said there's going to be almost 4 million fewer acres of winter wheat planted in the U.S. So that's really telling us that the economics for wheat production are not what they are. Those producers who typically shy away from the riskier crops from a weather standpoint of corn and soybeans in that part of the country are looking for alternatives, and they're finding it in the other crops. So we talked a lot about national level trends and farm finances, but it's important to note that there are some geographic areas of concern. It's not all the same in every part of the country. We think these trends might shake out a little differently in the local level.
And so one of the things we're really looking at, and perhaps we can get a better feel for this with some future barometer questions, we're really thinking about where's the acres going to go. You know, you've already said that wheat's down considerably. Soybeans, at least in the Eastern Corn Belt, look a little bit more profitable than corn. It's going to be interesting to see where this all shakes out. You know, what is the final acreage in corn, soybean, wheat? What are these trade-offs going to look like? And we won't know until we see the planting intentions, but this is going to be interesting to watch play out.
And it starts to feed back into how we set up the size of the plantings impacts the size of the crops. which will indirectly impact at the end of the day where commodity prices will be heading and the profitability. So we're wrapping up here, and just to recap a little bit, we've seen producer sentiment tick higher in recent months. It's been really coming from a strong increase in their expectations about the future, but also some improvements, some modest improvements in the balance sheet this winter as large crops and trending higher prices has improved farmers' position since harvest. But with that, we're very well. Producers have told us in the survey that this is still a tough time in the ag economy. The USDA's latest results says that it looks like 2017 is setting up to be another tough year in farm finances. And so we're going to keep surveying monthly ag producers. You can sign up to receive the monthly updates from purdue.edu/agbarometer. And you can also see our other work talking about the other issues we've talked about: farm finance situation, the crop budgets, where planting intentions and commodity prices might be heading in 2017. That's at our center website at purdue.edu/commercial-ag. Any final thoughts, Michael?
No, I just that we're going to continue to do this on a monthly basis, and we'll continue to try to weave in the barometer indices with fundamentals. I think that's kind of the unique contribution that we're really making with this barometer, and it fits in nicely with some of the other things we're doing in the center. So we'll continue to do that.
Well, thank you for joining us today, and we look forward to interacting with you in the coming months. Thank you.